We are now just a week away from Christmas, and then it's the new year. And as the new year approaches, we are keeping a close eye on our financial situations. Joining us now is Chuck Zodda, Managing Partner and Chief Investment Officer of the Armstrong Advisory Group. Chuck, good morning. Can't believe it's going to be 2025.
Yeah, hard to believe that we're almost through this one, but hey, getting excited for what we may see in markets and the economy in the new year.
So, Chuck, the Federal Reserve is expected to once again cut the interest rate, even though the inflation target rate has stalled. What effect do you see this having, and how big of a cut do you expect to see?
So I'll answer the last part of that first, where markets right now are projecting about a 98% probability that we get a 0.25% cut on the Fed funds rate. As far as how that affects other interest rates, remember, the Fed does not control every interest rate out there. So one of the things that we've seen, the Fed started cutting interest rates in September of this year. And to this point, they've cut the Fed funds rate by about 0.75%. Despite that, mortgage rates have actually risen by about 0.75% during that time, largely because mortgage rates aren't something the Fed controls directly. Instead, they're priced off longer term interest rates, and those have gone up simply because there's been a little bit more growth in the U.S. economy over that time period than people were initially anticipating. So I think as far as, hey, how does this cut potentially affect the economy going forward? It's tough to tell, and sometimes you can get these counterintuitive responses that end up happening. So I think we have to wait and see as to exactly how the market plays out. But a cut is expected today of about 0.25%.
It's been a very good year for the bulls with record highs. However, there's been more of a dip lately. What are you seeing for the weeks leading up to the new year in the stock market? And could we see a Santa rally, Chuck?
So it's interesting because typically what you see heading into the end of the year is it's one of the most bullish times for the equity markets seasonally. But again, it's been kind of a strange market over the last week or two where the vast majority of stocks in the S&P 500 have been selling off, but a few that have been gaining significantly have actually kept the index afloat pretty decently. We're still only about 1% off of all-time highs, even with many stocks being off far more than that. So it's kind of a dodgy situation that we find ourselves in right now. And I think it's one where it's unclear exactly how this resolves over the next couple of weeks, because normally you don't really see major sell-offs into year end. And so it's kind of hard to figure out exactly where this market is going to go. And there's a pretty wide range of outcomes, even in a short time period right now, which is not normally what we're saying heading into year end.
Now, is there a key New Year's resolution if you're an investor you're hoping will boost your 401k?
Well, I think obviously, look, from an investment perspective, you never know how any investment is going to perform in any given year. But the big one that I come back to when it comes to 401k plans is most companies at this point offer some type of 401k match for contributions, where, as an example, if you put in up to 3% of your salary into that plan, they will match and put an additional 3% of your salary in with you. And so this is one of those things where I always tell people, look, if you can find a way to hit that match without compromising elsewhere in your finances too badly, it's something where this is how you're able to get all of the compensation that your employer wants to pay you. Because if they're saying, look, we'll give you an extra 3% of salary or 5% of salary, and all you have to do is contribute to this plan, hey, that's basically a raise that they want to give you. It's just a raise that goes directly into savings. So I would look into, hey, does your plan have a match available in it? And are you taking advantage of it? If the answers to those are, hey, it has a match, but I'm not taking advantage of it, figure out if you're able to do so without compromising too much elsewhere.
And we are, of course, with the new year, awaiting a new administration in Washington come January. What sectors do you see thriving in a Trump White House?
So this is one of the toughest ones to pin down. And to give you an example, let's look back at the Biden administration, which historically over the last 4 years, very friendly to green energy, not as friendly to conventional hydrocarbon-based energy. And in fact, what we've seen during that time is that, for a number of different periods, conventional energy companies actually outperform their green counterparts. And the reason for that was, hey, if you're not necessarily supporting those conventional energy companies in the way that they want to be, maybe you end up seeing higher gas prices, which ends up working out to higher profits for those companies. So it can be kind of counterintuitive. And I think that this is something where you could be exactly right in terms of here's what I think the Trump administration is going to do from a policy perspective, but it might not have the market impact that you think on equities. You have to be right in two different places, first on the policy and then on how the market performs. And that's why I think trying to pick, sector winners for a 3 or 4 year period, it's really hard just because these unpredictable things can happen and the market might not respond the way that you think it does, even if you get the policy that you're expecting from the incoming president.
We'll see how the market shapes up. Chuck Zodda, Managing Partner, Chief Investment Officer of the Armstrong Advisory Group. Thanks for coming on today and happy holidays.
All right. Thank you. Same to you.